Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into financials, and also highlight the key risks and triggers going forward. Well, let's get straight to our first stock today. My colleague Sonal gets us a very special deep dive in GE Shipping.
Well, we are closer to the year end and Inside Out is on a special location. We are at Gallops in Mumbai and today we'll be focusing on GE Shipping. It is India's largest private sector shipping company and transports liquid, gas, solid, bulk products from one country to the other. The company has two business segments, shipping and offshore. Shipping would consist of different carriers and offshore consists of oil rigs and support vessels. There are four types of carriers. Crude carriers, which will carry crude products, product carriers, LPG carriers, and dry bulk carriers, which carry bulk products. The fleet is a very important parameter for any shipping company. And for GE Shipping, in its shipping segment, it has 43 ships of different kinds with an average age of 12.96 years. In the offshore segment, the total fleet is 22. If we talk about the financials now, there is cyclicality because of the way freight rates move. Calendar year 2021 saw freight rates at a 31-year low, and that is something which impacted business. But due to all the supply crunch that we've been talking about, in 2021, freight rates shot up and how. This definitely turned things around. While revenues in 6 months of FY23 are at 2,800 crore rupees, which compares with 3,500 crore rupees in FY22, company has been able to more than double their profits in 6 months versus FY22. So the 6 months profit number is around 1,200 crore rupees. In these revenues, 70 to 75% come from international trade and balance from India. But of course, freight rate volatility remains a key risk and concern because they can fall from these levels if cycle changes. Management did indicate in Q2, and I quote, with continuing high inflation and high interest rates, a global recession is possible. This would impact demand for multiple commodities, threatening our market. While this is about the risks, company has been able to maintain momentum when it comes to dividend payout to shareholders. Barring FY19 and FY18, when the company reported losses, dividend payout has been decent. And for the first time ever, company has become net cash, strengthening their balance sheet. Operating in the highly cyclical shipping industry, company's profitability fluctuated wildly at different times, though they have endured 4 shipping cycles by virtue of its 70-year presence in the industry. So let's take a deep dive into GE Shipping and understand their business. Well, as promised, it's time to take a deep dive into GE Shipping, and we are joined by the Group CFO and Executive Director, Mr. Shivakumar. Thank you so much for joining us here on CNBC-TV18 and this edition of Inside Out. Well, as we were discussing earlier, and the fact has been that right now the shipping cycle is extremely strong. We are seeing high levels as far as freight rates is concerned. But how long, according to you, do you think this will continue? Because in Q2, you had mentioned that the global recession that we are looking at, or maybe the commodity prices which are expected to come down, could impact business. What kind of changes are you seeing here? How do you protect yourself from the volatility that we see in the markets?
Good morning, Sonal. Thank you for having me on this interesting show. Yes, the markets are very strong. And we've seen that strength in the tanker market for the last couple of quarters. Yes, there is a fear of a recession which could affect demand for tankers going forward. We haven't seen that yet. We haven't seen that impact yet. There is a little bit of a demand overhang in the dry bulk business, which has sort of been drifting lower over the last couple of quarters. I mentioned that earlier as well. So tankers are still really strong. Maybe we'll get some impact of the recession as we go forward. As to your question on how we prepare for the volatility, we can't. You can't prepare for the volatility, frankly. You have to be able to ride it out. All you can do is to say the markets will go down at some point. And when they go down, you should be prepared for weak markets, and they could be weak for a significant period of time. Over a long period of time, markets will enable you to make money. The critical part is you need to survive the downturns in order to take advantage of the upturns. And that's what is our focus.
Okay, so in that case, can you just briefly explain to us, you have two segments, shipping and offshore. How does the business model really work? Because that's something that the investors and the viewers would really like to know.
Yeah, so the business model is, the commodity shipping business is a cyclical business. That's the first thing that should be kept in mind. And having been in business for 74 years now, we've been through several cycles. The organization remembers that. That's the organization memory. That's what helps us to always go through these markets, keeping some equanimity, that this too shall pass. If it's a strong market, we know that at some point it's going to get weak. If it's a weak market, we know at some point it's going to get strong. So you need to be aware of the cycles. Within the cycles, you will have volatility. So you won't just have a one-way up. It's like the stock market, right? You can have bad days in a bull market as well. Now, the business lends itself to taking debt. It requires you to take debt because it takes so much capital just to buy one ship. If you want to buy a new mid-sized product tanker, typically it will cost you about 250 crores. Okay? And that's in a reasonable market. Today it probably costs 350 crores. So, that's a lot of capital, and you take debt for that. And because it's a dollar business, you can take dollar debt. The problem with taking debt is, in a market like a year ago, EBITDAs on those kind of ships were $3,000 to $4,000 a day. You need much, much bigger earnings in order to meet your debt servicing. Today, the EBITDAs are $45,000 a day. The point is you need to go through those periods where, without, one, having to force sell your ships, and two, if those markets are that bad, you should be able to buy as well, because you need to then build up capacity in the weak markets. So that's what we look at. We keep a lot of cash to enable us to go through bad markets. So that's what we call a risk capital. That enables us to go through these bad markets and to buy in the bad markets. So that's the broad principle. We buy cheap because that's the one thing you can control. You can't control operating expenses beyond a point. Most of the costs are sort of fixed. They are inflexible. You can't do anything about the cost of people. 55% of our operating expenses, sometimes 60%, are people costs on the ship. For the people to crew the ships, and they are the ones who are running our assets, they're not very flexible in terms of costs. And we are okay with that. So you can't control that. You can control your capital cost. So the idea is to buy cheap so that you have the lowest break even and therefore you're competitive. That's what we look to do. We keep cash, and there are markets in which you will collect cash, and you will get times when markets are not cheap. Ships are not cheap. You have to wait, and you have to sit on cash and wait, like we are sitting on cash today. Sometimes it can get a little painful, be just sitting on cash and it's earning 2-3% in dollars. When your ships are making a 20-25% return on capital. But that patience, we know that patience will pay off eventually. So if you're going to be a cycle player, you will have times when you have a lot of leverage, and you will have times like today when you have no leverage. And you need to live with that, because in the knowledge that that's what will pay off for you in the end.
So it has brought in a lot of questions, what you just said. So right now is not the right time to buy ships, that's what you're saying. Is it a great time to sell ships? Because that's something that you did as well.
That's right. It is, yes, it is in the high part of the cycle. So we are closer to selling than buying. However, we are not happy with the amount of capacity we have. We wish we had more capacity. We would look at selling, yes, a little by little. You can't look at selling out a whole lot. And we will look at either selling, or you can charter out your ship. So you basically sell your capacity. You say that for the next 1 year, I'll lock in a rate. You take advantage of the high market easily, either by selling out the ship completely, or by locking in some capacity and realizing some of that profit of the sale in the charter period.
Okay, so do you have a minimum amount of cash that the company requires to keep? That yes, this much is the amount that should be in our books any point in time.
So we have something that we define as a risk capital. The risk capital is, we model the worst 3 years in the last 30 years for shipping, for our ships. And we say, therefore, you will make so much EBITDA. Now your debt servicing may be $10,000 a day of EBITDA. The risk case may be 4,000. That 6,000 is a gap you have to make up. And that $6,000 a day into the next 3 years will be kept in cash.
So, 75% of revenues coming in from international trade, rest is from India. Does this keep changing? And right now, is there a difference between the freight rates that we've seen in India and abroad? If there is, how much would that be?
There's not really much difference. In the spot markets, all the rates are the same. Okay, because it's an international market, it's settled. We don't get great preference or anything like that in terms of, you don't get a great premium for the Indian market or for the international market. So we go where the rates are best.
And what are the break-even rates for different kind of tankers, and what is your mix right now?
Yeah, so our fleet consists of 7 crude oil tankers, 18 product tankers. They carry refined products. We call them clean products, and 4 LPG ships plus 14 bulk carriers, dry bulk carriers. So that's a total of 43 ships. Typically, the fleet break-even is somewhere around $11,500 to $12,000 per day on a blended basis. The gas carriers tend to be a little bit higher than average. The crude tankers tend to be sometimes a little bit higher than average because there's more capital cost in them and because their OPEX is marginally higher. But they're all in this range, between $10,000 and $15,000 a day is the break-even rate.
So, I was reading some of the updates from Q2, and you did mention that you're looking at modernizing the fleet, right? Yeah. Average age is around 12.96 years in the shipping segment. Since you said right now maybe is not the best time to buy ships, then how long will you wait for it? Yeah. And what is the cash in your books with which you will be buying it, or will you be taking more debt for it now since you're in net cash now?
Yeah, so we will. It's inefficient not to have debt. So let me answer the last part first. It's inefficient not to have debt in our business. You should take the amount of debt you can afford to take. So we will take debt eventually when we get the opportunity. We will lever up as we did in 2017 when we did a lot of capex. We will wait till the prices are right. And we've seen this in the past. We saw this in the super cycle. We did a lot of investment because we thought this cycle is going to go on forever. This time is different kind of thing. That's a mistake. Even if you have to sit on cash for 3 to 5 years and then invest at low rates, it'll do better than buying in a high part of the cycle. And we've seen this. So what can happen is dry bulk markets are weak, right? So you may get a chance to buy some dry bulk ships. So if you get that and tankers are throwing out cash, you allocate it to dry bulk. We are in the capital allocation business. You allocate it to the dry bulk business, then maybe the dry bulk market recovers and produces cash flows, which you can then use to buy tankers.
So in the right kind of cycle or at the top, what kind of margins has the company made? The highest that you would have seen?
So we've made, I think, 3-4 years in a row, we made 40% return on equity in 2006 to 2009. That's a market. That's the kind of market that you can have. Even today, you on a run rate basis, we did 1,100 crores or so in the first half of the year. If you you shouldn't be just, doubling it for the full year, but that's still a 30% plus return on equity, really. So when the markets get very tight, then there's no limit to the rates that you can see. So typically the shipping brokers and researchers say, if you have utilization, that's a world fleet utilization crossing 90-91%, then the rates just take off. Okay, and then it doesn't matter because there is just a mad scramble for tonnage. And the customer will pay whatever it takes to get that ship to lift the cargo. And then it just takes off. Then it doesn't matter whether it's $50,000 or $100,000 a day.
So what is the utilization for your fleet right now?
When we talk of utilization, we are basically saying, are our ships all employed with customers, or are they waiting for cargoes? Currently, all the ships are employed, or they're just on the way to the port to load.
Okay.
So except for the time when they have to be in maintenance in dry dock, etc., our utilization is normally 100%.
Usually, how long is the maintenance period? Of course, it's a big vessel, but...
Yeah, typically a dry dock takes between 25 and 50 days, depending on the complexity, the age, the amount of work that you have to put into the ship. You have to do a lot of machinery overhaul. Some of the steel sometimes gets degraded. You have to replace the steel. You have to paint the ship, obviously, every time. So typically, a good dry dock will take 20-25 days, and something which requires a lot more work could take up to 50 days.
So how does scrapping work in this market? What are the plans for you here? Is it coming at a higher price as well?
Scrapping prices are high. They've come off quite a bit in the last couple of months. So prices are still quite high. But scrapping is really in relation to what can I make if I run that ship further. And if you're making lots of EBITDA running the ship, to carry cargo, then you wouldn't really scrap the ship. We haven't seen much scrapping happen in the markets over the last 4-5 years, whether tankers or dry bulk. So all of that is getting built up. And these ships will have to go at some point because they are aging, right? And when that happens, when they actually have to go, then you will find suddenly the supply is constrained. they will typically go when markets are very weak. Because if you're making positive EBITDA, you're making decent amount of EBITDA, why scrap the ship? You're making money from that ship, right?
So when you're basically the markets are weak, you would look at selling it. That would mean supply crunch. That would mean freight rates going again, right?
That's right. So that is sort of forming a little bit of a safety net for our business. One is that there is a lot of scrapping overhang. Ships are getting older, and so ships have to go out at some point. The second is the order book, which is for new ships to join the world fleet, is at 2.5 decade lows for tankers. Typically, these tend to be around 12 to 15% order book, and these are all at 5% now. So that's a great thing for our business in the sense that the future supply overhang is not there at least.
Okay, since last question, because you've been in the business for so long and you have told me how do you manage cycles in that case. So since clearly freight rates cannot be controlled, that is in the market's hand. You told me about a lot of costs being fixed. Generally, how do you control costs? Because now if you're talking about maintenance of fleets that is required, that will increase your operating expenditure, right?
That's right. So the time is the critical thing here. When I say that it takes a little more time to do a dry dock than say it used to with more efficiency. That's the one which really time costs money, right? It's a big capital item and that time is very is critical. In terms of running expenses, you can't really do much. It's a few $100s here and there, few $100 per day here and there. Dry dock expenses are big, chunky expenses. So a dry dock can cost anything between $1.5 and $3 million. There we try to optimize and say that let's try to minimize the amount of work or minimize the amount of expense which has to be put into the ship by doing the work on the run. So we do a lot of maintenance on our ships even when they're sailing.
So I know it's a forward-looking statement as well, but generally if freight rates remain at this level, you have already 1,200 crore rupees or 1,300 crore rupees you've done in first half, which is in terms of profitability you've surpassed FY22 as well. Right. If things remain the way they are, say next 2 to 3 years, how will you ensure that the growth remains? Will it be in terms of adding more fleet, more volumes, more orders? What is something that you're looking at?
If the market remains like this, we won't have growth. Because your capacity will remain the same, we won't be able to buy ships unless you get the opportunity, as I said, in dry bulk. So you could have tanker markets very strong, and if dry bulk markets collapse, then you can buy those. Okay. Otherwise, you won't have growth in profitability. Then the growth can only come from increased rates. You can only say that the ships which are earning $50,000 a day today, next year they will earn $60,000. That's the only growth which can come, because nothing else is going to change. The number of days will be the same.
Only realization growth, no volume growth,
no
so
volume
to say.
growth. Because unless we buy ships, and we don't have any ships on order, we don't have plans to buy tankers at least, because they're just very high in price. The only thing which can be anywhere close to our buying levels is dry bulk, and maybe we'll get to buy those. But otherwise, there's no growth driver for the profits.
Okay, so the cyclicality is something that makes the business very difficult, but you've been managing it well. Mr. Shivakumar, it was a pleasure speaking with you. Thank you so much for joining us here and explaining what really goes in the shipping business and how you are managing all the cycles that we just spoke about. Well, that's all we have about GE Shipping on Inside Out today. Stay tuned for more updates.
Well, that was a deep dive into GE Shipping. But we'll slip into a short break. You come back, we'll get you another interesting stock. Venus Pipes and Tubes is the stock on our Spotlight segment.